7 years ago, I invested my first ever dollar in the stock market, and fast forward 7 years now, here I am sharing and breaking down to you my full stock portfolio as a 19-year-old college student. In this video, I'll be showing you every single stock that I own in my portfolio. I'll also break down what I look for in a stock before I buy it, and at the end, I'll show you the performance with how much money I made to this day. Alright, so getting into it, my stock portfolio today is valued at $6,517.56, which is not a crazy amount, but honestly, I'm really proud of how I've been growing this portfolio over the past few years, and honestly, I'm just 19, I have a lot of time to grow this too. But before we go and check every single company that I own, I think it's pretty good to lay out what's my investment philosophy, what's my strategy, and what I look for in a stock, because that way it'll be way easier for you to understand why I picked what I picked. It's like what Morgan Housel said in the book The Psychology of Money, which, by the way, if you like finance, you really should read that book. It's really good. He basically said that when it comes to investing, everyone is playing a different game. Everyone wants different things in investing. You might want high risk with quick gains. Some people even buy meme stocks, crypto. Whatever it is, everyone's playing a different game. So a stock that might fit your portfolio might not fit mine, but that does not mean it is a bad pick. It just depends on what you want from it. And again, just by understanding my strategy, it will be way easier for you to understand my portfolio. Alright, so here is my investment philosophy. When it comes to my portfolio, I like to have a mix of stocks that are growing pretty strong year over year, but also having a mix of stocks that have really good dividend growth potential. The stocks that are increasing their dividend payments every single year at a high rate. And to me, this dividend growth is a green flag showing that the company is thriving, the company is doing good, that they're able to pay back their shareholders, but also at the end of the day, helps a lot compounding my portfolio over time. And another thing that I always look for a company when investing in them is what Warren Buffett calls a wide economic moat. So that's basically just saying that the company is really strong in the industry that they are in, and that it's really hard to replace them. For example, Disney, it is really hard to beat Disney's branding, for example. That is their wide economic moat. And my ultimate goal with this portfolio is to build long-term wealth. We're talking like 20, 30, 40 years from now, just to build long-term wealth for the future. I'm not really looking for the crazy gambles that I see people out there doing, like investing in penny stocks, high-risk crypto, even buying like Trump coin. Like, I do not want to be involved in any of that, but also I do not want to play too safe, too conservative, because I'm also pretty young. For me, it's all about finding the sweet spot between growth and dividend payments, which creates like consistency and compounding effect in the future. All right, so now that you know what my strategy is, let's go back to my brokerage account and check every single stock that I own. First up are my ETFs. Right now I have two of them. The first, it is my main ETF, and actually the biggest holding in my full portfolio. It is SCHD. As of today, I own 55.27 shares. That accounts for almost 22% of my portfolio, and that's also just over $1,400 in SCHD. And what I really like about this ETF, and why it's the reason that it is the biggest holding in my portfolio, is that it absolutely perfectly aligns as the foundation for my investment strategy. This ETF have a 5-year dividend CAGR of over 8%, which aligns perfectly with what I want. Dividend growth, but also because it is an ETF, it provides diversification, building that foundation for my portfolio. And they also pay a really good dividend yield of 4.02% right now, which provides me with good passive income too. So I reinvest everything back into the account. But something that I really like about this ETF that I honestly do not see much people talking about it is that it is an actively managed fund. So it is totally different than other ETFs like VICI or QQQ, which you've probably heard of before. Those ETFs, they track an index or they track a couple companies. SCHD, on the other hand, they just rebalance their portfolio every single year. And this rebalancing of their stock position every single year is actually based on a super specific criteria. First is that they should have at least a 10-year dividend payment history. They should have a market cap of over $500 million and a daily trading volume of over $2 million. And after this first filter, the stocks that are left are ranked in 4 equally weighted criteria. And those are free cash flow to total debt ratio, return on equity, dividend yield, and their 5-year dividend. And out of this ranking, just the top 100 stocks make the list for the SCHD fund, meaning that only the best of the best dividend growth stocks are a part of this fund. And that's why I love this stock. Next ETF is VTI, which is just a fund that tracks every single publicly traded company in the USA. Right now, I own just a single share of it, which is about 4.37% share in my portfolio. It's not that big a position for me, but it's still a pretty good ETF for diversification and consistent returns if that's what you're looking for. I'm also looking into reallocating this position into something that makes more sense with my strategy, but that's something for later anyway. Now let's go to the interesting part. Let's check the individual stocks that I own. This first one I've been adding a lot to my position because of the market dip recently, which is Google. As of today, I have 6 shares of Google, which is 15.6% of my portfolio and just over $1,000. So Google for sure is a really important part of my portfolio. But why did I invest in Google? First of all, we all know that they're a huge company, but they're also growing double digits every single year, and they're set to do so for the next few years also. And what I think is awesome about Google is that they are one of the leading companies, if not the leading company, in the AI race with Gemini. And if you didn't see, earlier this month, Google CEO announced a bunch of new stuff that they're developing with their AI and with Gemini too. First, they announced this thing called Google Beam, which is basically when you're in a Google Meet call or whatever it is, there's this AI system that creates a 3D avatar from your 2D feed. They also created this agent mode for Gemini, which is honestly pretty cool. It just serves as a personal agent for you for whatever reason you want a personal agent for. And the example they use when announcing this agent mode is of people trying to find an apartment with specific criteria with a specific price, and Gemini was actually able to bring back the apartment selected and also schedule a visit for you. So it is a pretty cool feature that people might use Gemini for. And one thing that they announced that I think is huge for the company is that right now Google Meet will have real-time translation. So Google AI is basically able to break the language barrier when you're talking online with someone, and that's honestly so cool. And the most impressive one by far is Google VO3, which now you're actually able to add audio to AI generated videos, and the quality of it is so damn good.
This ocean, it's a force, a wild, untamed might. And she commands your awe with every breaking light.
And despite all of that AI growth that they have going on, the stock is so undervalued. The company that might be the one leading the AI race is trading at a PE ratio of 19. And if you go to Seeking Alpha in their valuation tab, and you go here to Google's 5-year PE ratio average, you see that it is 26.4. That is 28% more than what it is being traded right now, meaning that essentially Google stock right now is being traded 28% cheaper than what it has been trading for the past 5 years. And with all of that combined into a single company, honestly, it's a no-brainer for me. Now moving on to the next stock, which is also a tech company, is Microsoft. Right now, I own 2 shares of Microsoft, which accounts for almost 14% of my portfolio and just over $900. And Microsoft, just like Google, it's also a huge company already, but they're also growing pretty fast. But something that's different from both of those companies is that Google is developing AI while Microsoft is implementing into their already super successful ecosystem. So they're just making their products better with AI in Outlook, PowerPoint, Word, and Excel. But you might think, how would Microsoft even implement AI if they're not developing it? The thing is that Microsoft have a partnership with OpenAI since 2019. Since 2019, they have been investing over $10 billion into OpenAI, which gives them premium access to all of the AI creations for them to implement in their products. And honestly, we're already seeing the result of that, especially in Azure, their cloud computing platform that is already the second largest in the whole world, but they're still growing at an impressive 30% year-over-year rate. That's just really good. And most people wouldn't even think of Microsoft as a dividend company, but they have been growing their dividend payments for over 20 years now at a dividend CAGR of over 10%. And that perfectly aligns with my strategy. This stock is a perfect mix between growth and dividend growth. Now going into my third stock and my last tech stock of this video, it is Broadcom. I only own a single share of Broadcom, and that accounts for about 3.5% of my portfolio. And the reason why I own Broadcom could be pretty obvious, AI, but they also have a lot of different things going on for them. First of all, they have a bunch of R&D and production facilities inside of the US because, as we all know, President Trump is really pushing for that, so that's good for Broadcom. And they also have a multi-billion-dollar contract to create chips for Apple, which will for sure boost their revenue for the upcoming years. So there's a lot of room for growth for Broadcom, but on the other side, they're also another really good dividend-paying company. Might be one of the best dividend growers out there. Their 5-year dividend CAGR is 13.6% right now, which is so good. So besides all of the room for growth with AI going on for them, they also have the dividend aspect. My next stock, going away from tech, it is my biggest position in my portfolio. It is VICI. This stock just ticks every single criteria that I put for myself in my strategy. They are of course a growing company, growing double digits every single year because people are using less cash every single day. But what is truly amazing about this stock is their dividend potential. They have a dividend CAGR of 14.77% right now. That is an insane number. And what makes it even better is that their dividend payout ratio is 21.6%, which is so low, meaning that they are actually able to grow their dividends at that fast pace. Another insane aspect about VICI is how profitable they are. They have a gross profit ratio of almost 98%. And on top of that, they're buying back shares every single year. They just announced a 30 billion share repurchase program, which brings a lot of capital back to shareholders like myself. And finally, another crazy aspect about VICI is their return on invested capital of 26%, meaning that when they reinvest their free cash flow back into the business, they're still really efficient with it, which is obviously great for the company. I mean, I could keep adding more and more stuff about VICI over and over, just making the case look even better. It is by far one of my favorite stocks in my portfolio. And to wrap up my portfolio, I have two stocks. They are Ultra Group and VICI Properties. Those are my last two positions, and both are high yield dividend stocks. And both positions together are about 4.88% of my portfolio, so they're not that relevant, but they do serve a good purpose for it. So starting with Ultra, you might think, why would you invest in a tobacco company since the industry is just going down? And honestly, the goal with Altria is to just bring income every single month and reinvest back into the portfolio. Right now, they pay a 6.8% dividend yield, which is already awesome, but my dividend yield on cost is 7.8%. If you don't know, yield on cost just means the dividend that I received right now divided by the price that I paid. Essentially, you just want your yield on cost to be higher than the dividend yield is. Also, Ultra has been growing their dividends for over 50 years, making them a dividend king. So this dividend payment is really consistent too. For VICI Properties, it's basically the same idea. They have a pretty good dividend yield of 6%, but on top of that, they're growing their dividend yield at a 7% CAGR. And the reason also why I chose VICI on top of the high yield is that it gives me some sort of exposure to the real estate market. So now let's check what truly matters. Let's check how I have performed this year. Okay, so as you can see on this graph here, the blue line is my portfolio and the yellow line is the S&P 500. So as we can see, my portfolio is up almost 3% year to date, which is around 1.2% more than the S&P 500. So that's not a lot, but it's always good to see my portfolio beating the market year to date. Now let's see how every single individual position of mine has performed. As we can see, Ultra Group's actually number one with 20.4%. And by the way, those numbers do not represent year to date or just overall. Then I have Visa pretty close to it, Microsoft 14%, and Google 5.55%. That is because Google actually had a big dip this year. Then I have Broadcom, Waste Management pretty close, VTI and SCHD just up a little bit. And the only one that I have in the red this year is VICI Properties. And here I just want to quickly show you guys how SCHD is my biggest dividend payer by far. It has paid me $57 overall and by far my top one. Now checking some other important data for the portfolio, I have a 1.71% dividend yield. But as you can see here on the side, this number means the average annual dividend growth in my portfolio, which is at 7.8%, which is really good. And this is about $111 every single year in dividend payments. I also plan on doing updates every single month of this portfolio here in this YouTube channel, being as transparent as I can, showing what goes on behind my decisions, myself buying the stocks, and all of my performance too. And the goal is also to learn a lot from you guys as we grow this portfolio together. So let me know in the comments what you think about my portfolio and if you have a stock that I own too. Subscribe to this channel if you like this content too, and do not forget to like this video as it will help to share this video to more people that like investing too. Thanks for watching, and I'll see you in the next video.